It arrives in a plain white envelope. No warning, no phone call, just a thin piece of paper slipped through the mail slot on a Tuesday afternoon in 2026, sitting on the kitchen counter next to a bag of groceries and an unopened hydro bill. The logo at the top belongs to your bank. The subject line reads, in cold black type, Mortgage Renewal Notice. For 5 years, you have not thought about this piece of paper. You signed your mortgage in 2021. You locked in a rate that felt almost like a gift from the universe, 1.5%, maybe 1.79%, maybe 2.1%. Whatever it was cheap. It was so cheap that you stopped thinking about your mortgage at all. You bought the house, you bought the second car, you took the family to Mexico in February, you renovated the basement, you lived your life. And now, the letter. You open it slowly because some part of you already knows what is inside. And there, on the second line, is the number that will define the next 10 years of your life. 4.5%. Maybe 4.79. Maybe even 5.25, depending on the lender and the term. The exact figure does not matter. What matters is what comes next on the page, the new monthly payment. The number that does not feel real. The number that, when you read it twice, makes you sit down at the kitchen table and stare at the wall. This is the moment. This is the renewal cliff. And in 2026, more than 1.2 million Canadian households are going to receive this exact letter, in this exact envelope, with this exact number. Welcome to the brutal reality of mortgage renewal in Canada in 2026. My job over the next 16 minutes is to walk you through what just happened, why it happened, who is responsible, and, most importantly, what you can actually do about it before that letter lands on your counter. Stay with me, because the math is worse than you think, but the strategy is better than you have been told. Let us do the arithmetic together, slowly, honestly, without spin. Imagine a typical Canadian household. They bought a townhouse in the Greater Toronto Area, or a semi-detached in suburban Calgary, or a bungalow outside Halifax. Pick your city. The principle is identical. They borrowed $400,000 in the spring of 2021. They locked in a 5-year fixed rate at 1.5%. Their amortization was set at 25 years. Their monthly mortgage payment, principal and interest combined, came out to approximately $1,599 per month. For 5 years, that number did not move. It was a fixed point in their financial life. Salaries went up, groceries went up, gasoline went up, daycare went up, property taxes went up. The mortgage payment, blessedly, did not. Now, the renewal. Today, in 2026, the same household renews their remaining balance, somewhere around $345,000 after 5 years of regular payments, at a 5-year fixed rate of 4.5%. Same lender, same house, same income, different decade. The new monthly payment. Listen carefully. $2,198 per month. That is an increase of $599 every single month. Almost $600 a month after tax. Gone. Vanished. Transferred from the household to the bank. Every month for the next 5 years. 60 consecutive payments. Do the multiplication. $599 times 12 months equals $7,188 per year. Over the 5-year term, that is roughly $35,940. Almost $36,000 of additional after-tax money that did not exist as a line item in the household budget 5 years ago. And that is for a $400,000 mortgage, a modest one by Canadian standards. In Vancouver, in Toronto, in Mississauga, in Burnaby, Mortgages of $700,000, $800,000, even $950,000 are common. Run the same percentages on a $700,000 balance, and the monthly increase climbs above $1,050 every month. This is not inflation. This is not a recession. This is not a stock market correction. This is a wealth transfer, executed quietly at the kitchen table when the letter from the bank arrives. And the most chilling part is this: nothing about the household has changed. Same job, same income, same house, same family. The interest rate changed. That is all. That single number on a single piece of paper has just rewritten the family's financial future. Every brutal story has its villains. In this one, there are three. And the first wears a suit and works in Ottawa. Villain number one, the Bank of Canada. The Bank of Canada is not technically the enemy. Its job is to keep inflation under control. But for the millions of Canadians renewing in 2026, the institution's pivot from emergency low rates in 2020 and 2021 to aggressive rate hikes in 2022 and 2023 has created the largest synchronized payment shock in Canadian housing history. In March of 2020, the overnight rate was slashed to 0.25%. In 2022, it began climbing. By the middle of 2023, it had reached 5%. The Bank of Canada raised rates faster than at any point in modern Canadian history, and the families who took out their mortgages at the bottom of that rate cycle are the families holding the bill today. Villain number two, the stress test, known as B20. Here is the cruel irony of 2026. When you applied for your mortgage in 2021, you were forced to pass something called the B20 stress test. The federal regulator, the Office of the Superintendent of Financial Institutions, required every borrower to qualify at a rate roughly 2% above their contract rate, or at 5.25%, whichever was higher. At the time, this felt cruel. You were paying 1.5%. Why on earth, you asked your mortgage broker, do I need to prove I can afford 5.25%? The answer, you were told, was simple. It was a safety net, a protection, a buffer, in case rates ever rose. In 2026, the safety net has become the floor. The hypothetical disaster scenario you were forced to plan for in 2021 is, today, your actual monthly bill. The stress test was not paranoia, it was prophecy. The borrowers who passed the test are paying the test. The ones who barely scraped through, who qualified at 5.25% on paper, but never truly budgeted for it, are now finding out in the most painful way possible that the regulator was not bluffing. Villain number three, negative amortization. This one is for the variable rate holders, and it is the strangest, most distinctly Canadian phenomenon in the entire renewal story. When the Bank of Canada raised rates in 2022 and 2023, hundreds of thousands of variable rate mortgage holders at the big six banks experienced something called negative amortization. Their monthly payments were fixed by contract. The interest portion of those payments, however, was floating. As rates climbed, the interest portion grew. Eventually, the interest portion grew larger than the entire monthly payment itself. What happens then? The unpaid interest gets added back onto the principal. You are paying every month, on time, in full, and your mortgage balance is going up. Some Canadian households in 2023 and 2024 owed more on their mortgages after 2 years of payments than they did when they signed the contract. A generation of homeowners discovered for the first time that paying your bills does not always mean paying down your debt. Today, at renewal, those families face a double punishment. They owe more principal than they expected, and they are renewing that larger balance at a rate roughly 3 percentage points higher than the one they started with. Let us talk about what $600 a month actually means, not as an abstraction, as a real thing, in a real household, on a real Tuesday in November of 2026. $600 a month is the family's discretionary budget. It is the line item the financial planners politely call lifestyle. It is the dinner out on Friday. It is the kids' soccer registration. It is the Costco run that used to feel routine. It is the Christmas gift budget. It is the weekend at the cottage, the coffee on the way to work, the streaming subscriptions, the spring break trip the kids have been counting on for 9 months. This is the middle class squeeze. And it is not happening to people who are reckless. It is happening to dentists, teachers, software developers, electricians, registered nurses, federal employees, small business owners, people who did everything right. People who saved their down payments, qualified for their mortgages, made every payment on time, and now find that the same income that comfortably supported a family of 4 in 2021 no longer covers the cost of staying in the same house. The squeeze does not announce itself. It arrives quietly. The family stops eating out as often. They cancel one streaming service, then another. They start packing lunches. They postpone the kitchen renovation. They sell the second car. They tell the kids that hockey, this year, will have to wait. And here's the part that the Bank of Canada, in its policy meetings, calls demand destruction. That is the technical term for what is happening at your kitchen table. Your reduced spending is the policy. The squeeze is not a side effect of fighting inflation. The squeeze is the plan. Multiplied across 1.2 million Canadian households renewing in 2026, this is a national contraction in middle-class consumption. Restaurants feel it first, then auto dealers, then home improvement retailers, then travel, then the broader economy. The renewal cliff is not a personal finance story. It is a macroeconomic event happening $400,000 at a time, one mailbox at a time. Now, here is where the banks step in with a solution, and here is where you need to be most careful. When you call your lender, panicked about the new monthly payment, the agent on the phone may offer you a way out. They will offer to extend your amortization. Your original mortgage was scheduled to be paid off over 25 years. With 20 years remaining, your renewal payment is $2,198 per month. But what if, the agent says gently, we stretched that amortization back to 30 years, or 35, or, and this is the new reality at some Canadian lenders in 2026, 40 years. At a 40-year amortization, your monthly payment on that same $345,000 balance at 4.5% drops to roughly $1,576 per month, almost identical to what you were paying in 2021. Crisis averted, right? Wrong. Catastrophically wrong. Here is what the 40-year amortization actually costs you. Over the full 40-year term, at 4.5%, you will pay approximately $410,000 in interest alone, on a $345,000 loan. You will pay more in interest than you originally borrowed. You will hand the bank one full additional house in pure interest in exchange for keeping your monthly payment steady. Compare that to the original 20-year amortization. On the same balance, at the same rate, total interest paid would be roughly $176,000. The 40-year option costs you, in raw interest, an additional $234,000 over the life of the loan. This is the wealth killer. The bank is not rescuing you. The bank is renting your future to you, at a price. And there is a second, quieter problem. At a 40-year amortization, the equity build in the early years is almost zero. For the first decade of payments, you are paying interest. The principal barely moves. If you sell in 8 years, you walk away with almost nothing. The mortgage extension does not just cost you interest. It costs you the very mechanism by which Canadian middle-class families have historically built wealth: home equity. The 40-year amortization is not a strategy. It is a sedative. It makes the pain go away today and triples it tomorrow. So what do you actually do? Whether your renewal is 6 months away, 16 months away, or already on the kitchen counter, here is the playbook. Strategy number 1, overpay aggressively right now. If you are still inside your current term, every dollar of prepayment between now and renewal goes directly against principal. No interest, no fees, pure principal reduction. Most Canadian mortgages allow you to prepay between 10 and 20% of your original balance every year without penalty. Use it. If you can throw an extra $5,000 at the principal before renewal, that is $5,000 that will not be re-amortized at 4.5% for the next 20 years. The math is brutal in your favor. Every $1,000 in pre-renewal prepayment saves you, conservatively, $2,000 to $2,500 in interest over the next 20 years. Strategy number 2, shop the renewal. Do not sign the first letter. This is the single most important sentence in this entire video. The letter from your bank is not an offer. It is an opening bid. The posted rate they send you is almost never the best rate available, even at the same institution. Pick up the phone, call a mortgage broker, get 3 quotes from 3 different lenders, then call your existing bank back and ask them to match. In 2026, the spread between the posted renewal rate and the best discounted rate available in the market is often 40 to 70 basis points. On a $345,000 balance, that is somewhere between $13,800 and $24,000 in saved interest over a 5-year term. The shop around is not optional. It is the highest paid hour of work you will do this decade. Strategy number 3, use lump sum privileges at renewal. In Canada, the moment of renewal is the one time in your mortgage life when you can throw an unlimited lump sum at the principal with no penalty whatsoever. If you have inherited money, sold an investment, received a bonus, or saved aggressively over the last 5 years, the renewal date is the moment to deploy that capital. A $20,000 lump sum at renewal, applied directly to principal, will save you roughly $9,000 to $12,000 in interest over a single 5-year term. The renewal lump sum is the most efficient debt repayment tool in the Canadian mortgage system, and almost nobody uses it. Strategy number 4, resist the HELOC temptation. When the renewal payment shocks the household budget, many Canadians turn to their home equity line of credit to plug the gap. Do not do this. A HELOC is variable rate debt secured by the same house you are already struggling to keep affordable. Borrowing against your equity to make your mortgage payment is the financial equivalent of borrowing from your left pocket to pay your right pocket, except the left pocket charges you interest. If the renewal payment is genuinely unaffordable, the conversation you need to have is not with your HELOC. It is an honest conversation about whether the house, at this rate, still fits the family. Strategy number 5, keep the amortization where it was. If your bank offers to extend your amortization at renewal, decline politely and ask for the alternative. A shorter renewal term, 3 years instead of 5, at a slightly higher rate, may be the better play if you genuinely believe rates will fall in the next 36 months. But never, under any circumstance, agree to extend the amortization. Hold the line on principal repayment, even if the monthly payment hurts. The pain of the higher payment is finite. The cost of 40-year amortization is permanent. Let us go back to the kitchen. The letter is still on the counter. The new payment is still on line 2. The number still does not feel real. But here is what changes today. You no longer open that letter blind. You know what the Bank of Canada did. You know why the stress test of 2021 became the reality of 2026. You know what negative amortization quietly did to your principal. You know why the 40-year extension is a wealth killer dressed up as a rescue. And you know which 5 strategies, applied today, can claw back tens of thousands of dollars before that letter ever arrives. The renewal cliff is real. The payment shock is real. The wealth transfer from middle-class households to chartered banks in 2026 is one of the largest in Canadian financial history. But you are not powerless. You are early. You are informed. And on the day that letter lands on your kitchen counter, you will not be sitting down to read it. You will be standing up with a plan already in motion. That is the difference, in the end, between the household that survives the renewal and the household that gets quietly relocated by it. The letter is coming. The math is set. The only variable left is you. And that, this year, is more than enough. If you learned something, like this video and hit subscribe. I'll see you in the next one.